Howdy, welcome back to Dion Talk. This video is going to be a little bit different because my Dilligaff switch is on today. I keep hearing a lot of channels that are talking about the housing crash is going to do this. The housing crash and transaction is going to do this. The interest rates are going to do this. The recession is going to do this. And I want to talk about how the recession, the housing crash doesn't freaking matter. So today I have two of my friends who've been investing over 20 years each. So they invested through the last housing crash. Both of them survived because of some strategies we're going to talk about today. How you can make a housing crash not matter. I have Michael Zuber from One Rental at a Time. I have Matt, the Lumberjack Landlord. Both of them have over 100 rental units, twice as much experience as I do. And because of what I've learned from them, I've been able to invest in such a way to where a housing crash isn't going to matter for me. And today we're going to make it not matter for you. Let's start with Matt. What do you think was the biggest risk people took buying houses in 2007 and 2008, just before the crash? Let's say we have the crystal ball. We know the crash is coming. What was the biggest risk that they took?
I think probably the biggest risk that they took, I would say it probably had to do with what the cost was relative to what the rate was. I think because the payment at that point, when you were reaching the most challenging times in those markets, they were getting non-fixed rate debt at the highest that it's ever been for an asset that was the highest it's ever been. So I think anytime you have all three of the things that matter when it comes to housing, all three of those are the highest they've ever been, I think you definitely have some risk that's incorporated there.
So you touched on the first thing, people buying properties right now, investments or first-time home buyer. Are you buying with adjustable rate mortgages? That's the
largely,
risk.
Yeah, largely.
That's the same risk. Largely, They're not. So if somebody's doing that today, right now, a housing crash will matter to you.
Yes.
So Mike, let's start with that. 2007, 2008, biggest risk.
So the other thing that people need to realize, and this is, I mean, I had a couple of comments yesterday saying this is going to be worse than 08. I'm like, I laugh at people that say that, having gone through it. And a lot of it's not only the adjustable rate mortgages and the resets, it's the fact that the mortgage loan was written with the teaser rate. So what does that mean? So the adjustable rate mortgage that Matt talked about, you could have a 1.9% fixed for 2 years that then would reset to 7, 8, 9. Yes, 10%. The loan was written and approved for the borrower at 1.9%, not the reset. So it is a lot easier to afford a property at 1.9 than it is 9.9.
Yes.
So when you write a loan like that and then the reset happens and it goes to 9.9, guess what? You can't afford it. And then, oh, by the way, your neighbors can't either. So the fundamental, the loan quality, the loan rigor, the Nina loans, no income, no assets, often called ninja loans, they were just bad loans with horrible underwriting. None of that is happening today. So you don't get yes, people will lose jobs. Yes, some people will be foreclosed, but it's not going to be this cascading impact of one after another because the loan was fundamentally a bad loan.
Right.
So that was us looking at 2007, 2008 with a crystal ball saying, okay, the housing crash is going to happen. If you did a ninja loan, no income, no job, no asset, you just told the bank, I make X amount of dollars and borrowed more than you should have. And you financed 105% of the loan so you can wrap closing costs into it. So you were negative equity from day one. And you had an adjustable rate mortgage. If you are doing any of that today, I hesitate to use words like this. Okay, but you're stupid. There's no better way to say it. So that's not happening. Ninja loans aren't happening. Adjustable rate mortgages did go from 3 to 11% of the total volume. And there are some investors like Matt who has a large portfolio and uses it on a small amount that he can take the risk on. That's impacting that too. It shouldn't be the person buying their house where their income barely covers the payment at current rates, hoping that they can refinance in 5 years, hoping that rates are less in 5 years. So now let's take it to today. It's today. You have high interest rates. You have high prices. We have a looming recession. We're either in it or it's going to happen or both. Now let's say we have the crystal ball. it's a year from now. And the largest 1 year crash that we've ever seen, we've seen peak to trough in certain areas of 75%, but market wide in a 12-month period, the largest we've ever seen is an 8.9% drop in prices. Let's say there's a 10%. This is going to be worse than 2008 in a price drop in a 12-month period. So just before winter 2023, prices are down 10%. You're sitting there right now today. You can buy your house or you can buy the next rental today. Or you can wait a year, wait for that 10% drop. Let's talk about that because I have two smart people here. One educated, one with math skills that I'm envious of. So let's start with Mike this time. Who's in a better position? The person who buys a rental today that's a great deal, that's going to get a 10% cash on cash return, that is going to drop in price 10% over the next year, or the person who waits and buys at a lower price a year from now?
So this is a great question, right? A lot of people talk about waiting and doing all of these things. I would tell you to do the math. As long as you are buying a deal that cash flows today, not betting on appreciation, fixed rate debt, the answer is pretty simple. You get the great deal today. When you get a great deal and you plan to hold it for your life, it doesn't freaking matter what happens in a year. So, okay, it goes down 10%, but what if rate goes up 1.5 points? What happens to rent in a year, right? Most people, certainly if you're making investment decisions, you don't make plans into a future that there's so many unknown variables. You can only deal with what you have today. We are only doing great deals today. 30-year fixed rate debt, no bet on appreciation, must cash flow day one, in current environment. If you want to take a gamble and bet, go for it. I mean, a lot of people are. I mean, I feel really bad for the people that listen to all these crash callers about 2020 and 2021 that are still calling 2022. Now some of them are calling 2023. There are some people that were calling a housing crash that are now calling stock market crashes. I'm like, can you do anything other than talk about a crash? I mean, geez, I guess it pays the bills, but whatever. So yeah, I mean, the whole deal of this investing thing is it's a journey. You never time the bottom. Market timing doesn't work in stocks. It certainly doesn't work in housing. Do a great deal today. I have no idea what a great deal is in your market. That's your job. It's not my job. That's your job. So yeah, that's my thought.
So the educated, the experienced 20-year investor says it makes sense with a 10% drop to buy the great deal today because you have the cash flow, you have the principal pay down, you have all of the benefits from taxes that you get over this next year. That 10%, I didn't even talk about what could cause it. It's probably higher interest rates, so it's going to cost you more. But now let's go to the math person. Matt, sometimes you spit out numbers that just would have taken me 5 minutes and a sideways calculator to get there.
Me too.
And a teenager. But how far would the crash have to be in a 12-month period for it to make more sense to have waited? Because I'm going to wrap up with I think the best deal I have because of a crash. But how big would that drop have to be in a 1 year period? So we're talking just 12 months, larger than, ignore historical, the largest one we've ever seen, for waiting to be the best bet.
Yeah. So I think that it depends on how much rates increase. That's the issue. Because for every 1% that the rates go up, the buying power goes down 10%. So this is where the deals last year, if you look at the last 12 months in the rearview mirror, you say the house now today, the same exact one at the same exact price of where it was a year ago, costs you 80% more. That's why all of us believe there's going to be this massive crash in transactions, is because the people that have to move will move. The people that have to sell will sell. But the people that don't have to, I think that's what will somewhat keep the markets tight. So guys, this is, in case you'd forgotten, I'm shopping for a house in Las Vegas, a single family home for me. I'm looking at the numbers, and I believe the market in Vegas, for the price point that I'm looking at, which is the move up buyer price point, I believe in that market for that asset, I believe in the next year could go down 20%. And so I am waiting. That's why I am waiting, because I believe that interest rates will probably go up another point. But as a second home, I can get an owner-occ second home loan, and I can buy at, basically with my credit, the lowest rate anybody can buy at. I can buy that second home. So I'm calculating that I think while the rate might be another point more expensive and we might be in the low to mid sixes, maybe high sixes, can we scratch 7? Absolutely. But I think the asset in that market with all the iBuyers, with all of the move up buyers going away, with all of the people now moving to that market, everybody that's going to move there from California already moved there. They're already there. Everything is slowed way down for the number of people becoming transplants. So that's the roll of the dice I'm willing to make based on a specific market, based on knowing what the interest rates, I believe I know what the interest rates are going to do. I believe they're just going to keep on going up. I'm banking on at least 1.5 points. But if I can get 20% off the asset, only then does it then make it a deal worth waiting for. Only then. And I could still absolutely lose. But because it's a second home, here's the worst thing that could happen. I don't buy something.
Sometimes I try not to pick on Matt.
But not today.
Perhaps. But not today.
It could be that you're waiting because you have a job and you know that you're not going to get to enjoy all of the time that you would at that second home that someone like Mike or myself could do because our family was important enough for us to stop working.
It's true.
Is that enough of it? I think that was enough for today. Pink Panther's still coming.
Wow.
So a 20% crash that you're reasonably certain of in that local market, because real estate is local.
Well, I
justifies
to be very clear. It's local market and sub market. He was very clear because, again, if you don't know, Matt is searching for the move up buyer, which in Vegas is 750 to $1 million. Median price in Vegas, let's call it 500 for easy math. He's not talking about below the median falling 20% because that mathematically doesn't feel good.
Mm-mm.
But if you want to play in the new market where they've overbuilt, oversaturated, all the bagfuls of money of California have already come and nobody else is coming, you kind of make sense. So I want to give that little caveat. He's being very specific on his buy box.
Yeah, and the only way you get there is by a ton of research. I've been looking since May, and since May, inventory in that segment has gone basically 4x or 5x. Mm-hmm. And the builders, the Toll Brothers of the world and things like that, while they're not building the new stuff, they're finishing existing stuff.
Correct.
And that's more supply that's going to be coming onto the market in a price point that is your move up buyer that's not going to be able to get what they wanted for their house. And so, yeah, I mean, a lot of work has gone into this, but I could lose, but
you still have a job. So that's okay.
Yeah, exactly. I've got the job to make it up. I got the W-2 that can bridge the gap for me. But that second, because it's a second home and I don't need to have it, I can always wait. And all I lose is money I didn't basically put out there.
For that second home, waiting for that 20% crash, it totally makes sense. For that investor, here's why you might not want to do that. If you're working towards financial freedom and making work optional, quitting a job you hate or moving to a job that you just like more, or not having to work. I purchased a house before the 2008 crash. I purchased it for $198,000, $104,000 was the loan. So about 5%, 105% financed with an adjustable rate. Then I refinanced into an adjustable rate to pay my ex her portion of the equity just before the 2008 crash. So I owed as much as possible on a house that was about to lose value. I couldn't, I got laid off. I rented the house out to a friend without a lease and was losing money, tried to give the house away. I call myself lucky because that house lost so much value after that crash that I had to turn it into a rental. I couldn't give it away. As a rental, it made money. Once I got educated, got my friend out, got an actual tenant in there with a lease, rents went up after 2008. If there was a housing crash and a recession, 4 out of the last 6 recessions, home prices went up. Rents have consistently gone up. Since we started tracking the data, there's never been a 5-year period where rents have gone down. So as a buy and hold investor, if you absolutely knew that the prices were going to crash the same as the largest crash we've ever had in a year, that's still less than 10%. Both of our investors here would say it's the time to buy now. Hyper localized in your market, if you knew it was going to crash 20% and it's just a second home, where if you delay that purchase, it isn't going to cost you years of your life to have to work. Because here's the last thing I want to wrap up with. In 2020 and 2021, I bought 3 deals that over doubled the size of my portfolio and made it very easy for me to quit my job and walk away from $2 million handcuffs and never look back. While all of the channels were saying there's a crash coming, there's a correction coming, you shouldn't be buying, there's a pandemic, there's an eviction moratorium, there's all these reasons. Right now, there's high rates and high prices and a recession coming, and you shouldn't be buying. It's always a good day to buy a great deal, and you are going to be alive in 5 years. Start investing like it. Even if there was a 30% crash, in 5 years, you are going to wish that you could buy properties at today's values. Matt, if somebody wants to reach out with follow-up questions, how can they find you?
Lumberjack Landlord on YouTube and Instagram. In my new series, I am actively going through a lead order from the state, and I am actually going to document every step of that process so people can understand exactly what that actually feels like and what the process is, so they can better prepare themselves if it ever happens to them as a landlord.
Awesome. And Mike, if they want to reach out to you, how can they find you?
One rental at a time. Do my live streams 8 a.m. Saturday. Go for 60 minutes. Get on early so your questions get answered.
Thank you both. Until my next video, thanks for coming to my Dion Talk.
We're sorry, the number you have dialed is not in service at this time.